A lot of you have been asking questions about starting to invest. Some of these are basic questions, while others are a bit more advanced. That's why I decided to make a video that covers everything, or almost everything. I will also help you understand what to invest in and talk briefly about taxes at the end. So let's dive right in. First of all, why invest? Well, you want to make your money grow. In the past, the stock market has typically provided an average annual return of 10% before taking inflation into account. Other types of investments usually don't come close to that. Think of it as the opposite of inflation. Take an apple, for example, which used to cost 20 cents when you were young, and now it costs $1 after many years. However, you can't just save that 20-cent apple and sell it for $1 later on. Instead, you purchase shares in various companies involved in producing that apple and the grocery stores involved in selling those apples. And by doing so, you can benefit from their growth and make your money grow alongside them, thus not only keeping up with inflation, but also growing your money. Now, what could you invest in? You could invest in individual stocks / individual companies like Apple and Tesla, or you could invest my way and invest in a basket of stocks known as index funds. What is an index fund? An index fund is a big basket that holds a lot of different stocks from many companies. Instead of buying shares of just one company, you can buy shares of the entire basket of stocks. This way, your money is spread across different companies and different sectors. The cool thing about index funds is that they're designed to track something called an index. An index is a list of specific companies that are chosen based on certain rules. For example, a popular index is the S&P 500, which includes 500 big companies from different industries. When you buy shares of an index fund that tracks the S&P 500, you're essentially buying tiny portions of those 500 companies. So, if one company does not do well, it does not hurt you as much because your money is invested in many other companies. This is a way you reduce your risk, because if one company does poorly, it won't have a big impact on your overall investment portfolio. Index funds are considered a good option for long-term investing because they tend to provide steady growth over time. The S&P 500 consists of 500 big and successful companies in the US, like Apple, Microsoft, Coca-Cola. Another well-known index is the Dow Jones Industrial Average, which represents 30 major companies in the US, such as Walmart and McDonald's. So you could purchase individual stocks, or you could purchase an index fund, which consists of a basket of stocks. In my own portfolio, I mostly have index funds making up around 90% of my portfolio, while the remaining 10% is allocated to individual stocks. The thing about individual stocks is that you have to keep a close eye on those companies and make sure they don't lose relevance. Let me give you an example. Back in 2017, a well-known finance magazine suggested investing in Macy's stock. However, since then, the stock has been on a constant decline. This is precisely why individual stocks require constant monitoring. On the other hand, index funds are more convenient, as you simply set them up and leave them without worrying about constant supervision. The next thing you might be wondering is, how do you invest in index funds? To buy or sell index funds or individual stocks, you need to open an account with a brokerage firm. There are many options out there, but for long-term investors like yourself, I recommend Fidelity or Charles Schwab. Personally, I have all my accounts with Charles Schwab, but Fidelity is just as good. One problem I've noticed with beginner investors is that they spend too much time deciding which brokerage firm to pick. Let me assure you, picking a brokerage firm is likely the easiest part of this entire process. So choose one and move on, and don't spend more than 5 minutes on this decision. When you visit the account opening page, you'll find many choices. This is Fidelity's website, by the way. You can choose to open different types of accounts, but if you're planning for retirement, you have two options: a traditional IRA or a Roth IRA. With a traditional IRA, you can contribute money to the account before paying taxes on it. This means that the money that you put in is tax deductible, which can lower your current tax bill. The money in the account grows tax-free, meaning you don't pay any taxes on it until you withdraw the funds in retirement. When you withdraw the money in retirement, it is taxed as ordinary income. In contrast, with a Roth IRA, you contribute money to that account after paying taxes on it. This means that the money that you put in has already been taxed. The money in the account grows tax-free, and when you withdraw the funds in retirement, you don't have to pay any taxes on it. This can be beneficial if you expect your tax rate to be higher in the future, or if you want tax-free withdrawals in retirement. In simple terms, the main difference between the two is how and when you pay taxes. For most people, it makes sense to go with the Roth IRA option option. A Roth IRA does have limits on how much you can contribute. For tax year 2023, you cannot contribute more than $6,500 in this account. There are also income limits with a Roth IRA. It's just something to keep in mind. You also have the choice of opening a regular brokerage account. This is similar to a Roth IRA, but without tax benefits. If you want to contribute more than the maximum limit of $6,500 for a Roth IRA, you can open both a Roth IRA and a regular brokerage account. It's worth noting that people who are working towards early retirement have both of these accounts. The brokerage account has no restrictions, while the Roth IRA has some rules regarding when you can withdraw the money. Having both can be helpful. However, if you're just starting out, it is recommended to begin with a Roth IRA, get familiar with the process, and then consider opening a brokerage account. Now that you know what an index fund is, and let's say you decide to open a Roth IRA with Fidelity, what comes next? Well, you'll have to buy investments within that account. I want to quickly mention a common mistake that beginners often make. Some people open a Roth IRA, deposit money in that account, and assume they're done. That's not the case. You have to use the money that you deposit to actually buy investments. I recently had someone reach out to me concerned that their account had not shown any growth or decline in the past 3 years, and they were worried if they were doing something wrong. It turned out that they had missed the most important part, which is buying investments in the account after you deposit the money. Okay, so what do you purchase and how do you decide what to purchase? Let's look at a few funds and see if we can decide. We briefly talked about the S&P 500 fund, but let's talk about it in more detail now. If you're investing in an ETF that tracks the S&P 500 index, you're essentially investing in all the 500 companies at the same time, or you're holding a very small piece of all these publicly traded companies. Yes, this includes big names like Apple, Tesla, Microsoft, you name it. You will be invested in all these companies within that index. And that's the advantage of investing in index funds, aka diversification. You've probably heard the saying that don't put all your eggs in one basket. So with exchange traded funds, you get instant diversification. The S&P 500 is focused on US companies, but you can also buy funds that track stock markets all around the world. Additionally, you can buy funds that track bond and real estate markets all around the world with just a click of a button. Here's another fund, VT. This is a Vanguard fund that invests in both US and foreign companies. Why would you want to invest in foreign companies? Because you don't want to rely entirely on the US economy. You want to diversify across different countries and different sectors. Now let's take this a step further. Other than what the fund is holding, what else am I looking for? I'm also looking at the expense ratio of this fund. In simple terms, the expense ratio is like a fee that investors pay to the fund company for managing and operating the fund. A higher expense ratio means a larger portion of the investor's money is being used to cover the fund's costs, potentially reducing the overall returns on investment. Conversely, a lower expense ratio means a smaller portion of the investor's money is going towards these expenses, which can be beneficial for long-term investment growth. So long story short, you want to look for funds with less expense ratio. It's very important that you pay attention to these fees, as these fees can quickly compound. My aim is for this number to be less than 0.30. What are some additional funds that I can recommend? On my Facebook page, I shared an example of a diversified portfolio. Please remember that this is only an example. In the portfolio, most of the investments are focused on US companies, especially the S&P 500. Additionally, I included 2 international funds which make up around 20% of the portfolio. Then there's also investments in bonds for added diversity. If you want to buy VOO, which is the S&P 500 index fund, here's how you do it. First, you log into your brokerage account. Make sure you have enough money in the account by depositing if necessary. Then proceed to make the purchase. This is the current price of VOO. So this is the amount you would need to purchase 1 share. If you encounter difficulties during this process, you can always call the brokerage firm and ask them to confirm that your purchase is as you intended. Generally, brokerage firms are quite helpful when it comes to assisting with such matters. While making the purchase, you will notice that there is an option to reinvest dividends. Make sure to check this box. In simple terms, dividends for an index funds are a portion of the profits earned by the companies that make up the index. When you invest in an index fund, you essentially own a small piece of all the companies in that index. Some of these companies distribute a portion of their earnings to their shareholders, known as a dividend. Profit sharing, in other words. Dividends can be paid out to investor in cash, meaning you receive the money directly in your investment account, or they can be reinvested back into the fund, which is the option right here. When you choose the dividend reinvestment option, it means that instead of taking the money you earned from owning that index, you decide to use that money to buy more of the same fund. So basically, you're letting your profits work for you by automatically reinvesting them to increase your investment in that fund. So let's take VOO as an example. The current price is $395 and you buy one share at $395. The dividend you get every quarter for holding just one share of this fund is $1.48. So if you reinvest this dividend, you're essentially buying 1.48 divided by 395 equals 0.00374 more shares of the same fund. So instead of one share, you now have 1.00374 shares. Now imagine if you keep doing this over and over again. By choosing the dividend reinvestment option, you allow your dividends to be used to buy more shares of the index fund, effectively increasing your ownership in the companies within the index. So while I'm saying click this option, make sure you understand why I'm saying this. Now that you understand what an index fund is, let's talk about the returns that you can expect. The market goes up and down a lot, but historically, the S&P 500 has given investors an average annual return of nearly 10%. This includes all the economic downturns and the crises we have experienced in the past 96 years, such as the housing crisis of 2008 and the dot-com bubble. But if you look at the big picture, the average returns tend to be around 10%. Remember, we're talking about the average returns of 10%, which means that in one year, the S&P 500 could go down by 10%, but in the following years, it could go up 20, 30, or even 40%. To illustrate this, let's use an investment calculator. You can use any compound interest calculator online, but this one is from investor.gov. Imagine you start with an initial investment of $1,000 and you contribute $500 per month. If we assume a future average annual return of 10% and we hit calculate, you can potentially have around $1 million in 30 years. And this requires just a minute of your work every week. And I get this all the time. Who wants to wait for 30 years? If you want your account to grow even faster, increase your contributions. Now let's go back to the calculator. What if you have $1,000 to spare every month? And instead of choosing 30 years, you put 25 years. By the end of the 25th year, you could potentially have a portfolio of $1.1 million. This brings us to the concept of compound interest, which some people find very difficult to understand. The longer you give your money to grow, the more time it has to grow into something substantial. Going back to the first example, if we change the time to 40 years, you could potentially have $2.7 million. Feel free to play around with the calculator and find the numbers that work for you. One important rule of investing is to minimize the amount of taxes that you pay. To do this, it is a good idea to hold your investment in tax advantage account whenever possible. We discussed the Roth IRA, but besides the Roth IRA, there are other tax advantage accounts like the health savings account and the 401k that you should explore. If you want to learn more about the sequence of investing, this is a very helpful video that I will link in the description box below. Secondly, when you sell stocks and make a profit, you will likely pay capital gains taxes on those profits. There are two types of capital gains taxes: the short-term capital gains tax and the long-term capital gains tax. The short-term capital gains tax applies to profits from selling an asset you've owned for less than a year, and it is taxed at the same rate as your regular income tax bracket. On the other hand, income from long-term capital gains tax applies to profits from selling an asset you've held for longer than a year, and the tax rate can be 0%, 15%, or 20%. Usually, long-term capital gains are lower than the short-term capital gains. This means that holding your stocks for at least a year can result in paying less taxes when you sell them. Why am I telling you this? Well, whenever possible, aim to hold the asset for at least a year so you can qualify for the long-term capital gains tax when you sell. This rate is generally lower than the short-term capital gains rate for most assets. In this video, a wide range of topics related to investing were discussed, starting from the basics and progressing to more advanced subjects like taxes. While there's still much to learn, it is important to get started even if it's with a modest amount of a few $100. The key is to gain an understanding of what you're doing and gradually consider investing more as you become more comfortable.